A lot of IG clients have been expressing an interest recently in gold and how to get exposure to the precious metal. One such way of doing it is to get into gold mining companies, those companies that are producing gold and getting money onto the balance sheet. Let's catch up now with one such business, AIM-listed Caledonia Mining. It's a Zimbabwean-focused mining company. It's exploration, development, as well as gold production from its Blanket mine. It has a 64% interest in that mine, but 100% interest in other gold mining claims in Zimbabwe. It's recently said that first quarter output this year was up 6% at 17,050 ounces of gold. Mark Learmonth is the chief executive. He joins us now. Mark, welcome. We've spoken over the years about this business, and I'm pleased to see that you're expanding outside the Blanket mine. I'll get into that in just a minute, but I know that headwinds have been building and have perhaps maybe come to a head in the first quarter. Describe where we are in terms of production at the moment and how things are going for the company.
Well, at the moment, things are going very well. And when I say at the moment, that kind of implies that I don't expect that to continue. So that's incorrect. Things are now going very well. As you've said, Q1 production was 17,000 ounces, higher than the equivalent period in 2023, and also bang on target in terms of our own internal expectations. But it's fair to say that whereas things have now improved and the business is now generating, it's producing gold. It's actually currently producing slightly ahead of our expectations. Clearly, the gold price is much stronger than we'd expected. We're now seeing our costs beginning to come down quite smartly, and that's in very stark contrast to what was actually quite a difficult year for us in 2023, when we had disappointing production from the Blanket mine, which then flowed through into disappointing cash generation. Then on top of that, a disappointment at a small scale oxide project, which we'd hoped to use as a way of earning some relatively small early cash flow at the Bilboes mine. So what we're seeing now in sort of early 2024 and moving forward in 2024 is the core performance of the business has improved substantially, gone back to pretty much where it was, obviously helped by the higher gold price.
But I think if I'm right in saying that the recent release says an all-sustaining cost has almost doubled to $14.45 per ounce, $1,445 an ounce. That seems to me like a very high number compared to what it was. What's going on?
It does look relatively high. And it really comes down to a couple of issues. First is that we have seen some increase in our core on-mine cost, probably about $100 an ounce. We also saw an increase in our G&A bill, which was largely driven by one-off events in 2023, in particular advisory fees relating to the acquisition of the Bilboes asset. But the biggest effect that we've seen pushing up the all-in sustaining cost is an increase in sustaining capex, which previously was very low and is now something like $400 an ounce. And that is purely because we commissioned a very large capital project at the Blanket mine in early 2023, which means that and as we continue to do further work on that project, so we're doing further work on the tailings facility, we're doing further work on underground development, because that project is now commissioned, the capex on that further work, which was previously categorized as expansion capex, is now categorized as sustaining capex. So the overall capex bill hasn't gone up. It's just moved from one pocket to the other. And that's why it seems to have quite an alarming effect on our all-in sustaining cost. Those costs will come down as we move forward, as the capex that we're continuing to spend on the tailings facility and the capex that we're continuing to spend on the underground development, as that tails off over future years. But it does look rather worse than the actual reality. It's an allocation issue.
I also know that over the years you've been investing in new power sources because Zimbabwe, like a lot of African countries, has a problem in sustaining power all the time to businesses. And as I say, Zimbabwe is no different from most other countries. My understanding is you've now got around about 25% of your power at the Blanket mine now provided for you internally through solar panels, which obviously is a right sort of investment to make. Do you intend to increase this? Can you increase it to try and avoid the power outages that you've had, which cause all sorts of problems for any business?
Well, again, that's a very interesting question. The solar project has worked very nicely for us. Whereas I think previously we were using about 4 million litres of diesel a year. We've reduced that to about 1 million litres. So clearly there's a cost saving there because the cost of diesel generated power is about 45 cents a kilowatt hour compared to 1 for solar power. So there's been a big benefit there. In terms of our exposure to the grid, yes, the power that we're getting through the grid is subject to fluctuations in terms of, is it on, is it off, or in particular we have problems with the voltage. But we can, if needs be, even if the grid sort of fails completely, we can fall back onto diesel. So it's not as though we're at risk of complete shutdown if the grid fails. But yes, you're quite right. We are now exploring the option to add another 10 megawatts, maybe 10, maybe 8, to the existing facility, which currently produces 14, with a view to further de-risking us and further benefiting from the cheaper solar power. So yes, that is something that's been quite nice for us. It's been a good investment.
Talking about investment, I know you've been investing in your flagship asset, the Blanket mine. As I said, you've got a 64% interest. And I know over the years you've been expanding the mine, you've been expanding the mine life length and so forth. What are your plans now from this point on to continue to benefit from what has been a very profitable hole in the ground?
Yeah, so we have invested very heavily in the Blanket mine over the last 7 or 8 years, and we've effectively constructed a new mine underneath the old mine. So the old mine, which had been running for over 100 years, that extends down to a depth of about 750 meters below surface. What we've done is we've now built a new mine which extends from 750 meters down to about 1.2 kilometers. We've also restarted exploration work, which has resulted in we put out a couple of press releases over the last sort of year, 8 months, showing some really quite good exploration results. That will translate into a revised resource base and a revised life of mine plan, which we expect to publish very shortly. So you will see the benefit of that investment flowing through in terms of more ounces and a longer mine life. In terms of the of converting the new infrastructure into a continuing profitable operation, we do still, even though it's working and it's making cash for us, and it's a nice business. There's more work we can do to optimize that in terms of improving and reaping the operational efficiencies that are available from a much bigger, more efficient shaft that we have now, instead of the somewhat higgledy-piggledy infrastructure that we've been working off over the last sort of 15 years. So it's still somewhat a work in progress, but we are over the hump in terms of quite high levels of capex, and we're in a position where we've got much more operational flexibility, and clearly we've found the ounces. So that's been a good investment.
Yeah. Is that investment paying for all your other interests and moving those ahead? We've got the recent Bilboes acquisition, of course, we've already referenced. I believe that's an open cast prospect. And my understanding is a feasibility study is coming on that very shortly. We've got Motapa and Maligreen as well. Are you able to sustain yourself internally in terms of funding these extra assets from the income from Blanket, or are you taking on money from outside sources?
No, we have used cash from Blanket quite aggressively to fund those strategic developments outside Blanket. So, we bought Bilboes. We paid for Motapa in cash. Effectively, we paid for Maligreen in cash. Bilboes is a much bigger asset. Bilboes has 2.5 million ounces at 2.3 grams a ton. We bought that for $65 million, but that's clearly beyond our cash resources. And in any event, I don't think a cash deal would have been, a cash deal certainly wouldn't have been on the table for us because the vendors wouldn't have sold for a cash price at 65 million. So we funded the acquisition of Bilboes using equity, but then we've also used our own internally generated cash to clean up the balance sheet, which was somewhat distressed, and also to do some of the early stage work. So we're using blanket cash to push the projects forwards, but in terms of turning Bilboes to account, that's going to be a very big project, targeting 170,000 ounces a year. And now there is already a feasibility study on our website, which shows a capital cost of peak funding requirement of about $250 million. So we expect that we can fund a good proportion of that through debt. We also can make some contribution using our internal cash resources and the cash we expect to develop. But inevitably, for a project of that size, there will be some further dilution, either through public equity markets, or we'll even consider looking at things like introducing a joint venture partner. But the fundamental approach that we adopt to this is to fund it in a way that maximizes the NPV uplift per share for Caledonia shareholders. We're absolutely not interested in tripling production and tripling the number of shares in issue, because that just means that we've gone to a lot of hard work to effectively stand still. So we are very focused on uplift in NPV per Caledonia share.
Just very quickly, from the numbers you've said, the Bilboes mine is going to be on a par to the size of Blanket. Is that right, or is it going to be bigger?
No, much bigger. No, much bigger. Blanket produces 80,000 ounces a year. Bilboes will produce 170,000 ounces a year, so it's more than twice the size. It's very big. And I think what is genuinely exciting is, we've got a Bilboes with an existing resource base and a feasibility study, admittedly one that we're updating. But what we've also done is the Motapa assets that we bought as well. That is immediately adjacent. It abuts to Bilboes. There's two halves of the same sort of group, and that we believe that has the potential for being a much bigger, more attractive property than Bilboes. It does need 3 or 4 years of exploration work on it, but we're very, very excited that we've actually built a portfolio of very attractive assets in Zimbabwe, which creates a trajectory of growth for this business over the course of the next sort of 10 years or so, which I think is outstanding.
Yeah. Let me just bring up a share price chart, Mark. We can reference where we are in terms of the movement. This chart goes back to 2015, so we've got several years under our belt here on the chart. We got this high point we had back in July 2020 at 1848. Here we are now at 820. What's represented by this? Bearing in mind, if I were able to overlay the gold price, of course, we know where the gold price is going in an upward direction. We don't seem to have got any benefit in the shares because, I guess,
there's quite a lot to say about this chart. The peak that you see in the summer of 2020 that you're looking at there, what's the share? Are you looking in dollars or sterling? What's the share price you see there?
This is the London listed, AIM listed shares.
Okay, so that would be less than that would be about sort of £17 or something, I'd guess. I mean, $27 is the number I've got in my head. That was when, quite by surprise, Caledonia was included in something called the Russell 3000 index, which typically is only available to US companies. Now, we're not a US company, we're a Jersey registered company, but the bulk of our trading, the vast majority of our trading, takes place on the New York Stock Exchange. And so we were categorized as a US company, and we were quite surprisingly included in that index. That took us by surprise, but it also took the North American market by surprise and gave rise to quite a lot of forced buying as the passive funds which track the Russell 3000 had no choice; they had to buy us. And so at that share price, that implied a discount rate to our own estimate of internal cash flows, a discount rate of 1%, which clearly a 1% discount rate, whilst I'll take it, isn't a realistic valuation discount rate for a single asset, relatively small mine in Zimbabwe. So that price there was somewhat I'd say overbought
Yeah.
for reasons I've just outlined. So the share, it was to be expected the share price would come down from that. And I think the relatively poor performance we've seen certainly over the last 12 months when the gold price has been relatively strong, I'm afraid is driven by disappointing news flow in respect of the core operations at Blanket Mine, which were frankly very disappointing in the first half of last year, and a disappointing start to a small oxide operation at Bilboes that we'd hoped we could use as a quick way of scoring some early cash flow. So I think we've not helped ourselves by the disappointing news flow. But as I think as we started out, we're confident now that the operations at the core business have improved. There's good news flow coming through in terms of production, profitability, resource development, and we're making reasonable progress in terms of our thinking about how we're going to commercialize the Bilboes project. So you're quite right. Our share price has been disappointing, especially in the context of the higher gold price.
Yeah. So look, I know you've got no control over the share price. Given what you just said about the business, where you expect the profit to come in at in future quarters and so forth, what is a realistic price then? You say that 820 is undervaluing it, but at the same point, that 1800 level a couple of years ago was overvaluing it at an overbought price. What do you consider to be a reasonable price for shares? You're a shareholder. I guess you've got a view in mind.
I am a shareholder. I'd have thought, as we are at the moment, I mean, so the difficulty is the market doesn't have all the information that certainly we have in our heads about where we believe we can take the Bilboes project.
Mm-hmm.
And the job we're going to have over the course of the coming months is to convert the knowledge or the belief that we have in our heads about what we can do with Bilboes, expressing that in a way that is compatible with our reporting obligations, particularly in North America, which are quite onerous. So you asked me a very simple question. The answer is a very difficult answer because I'm answering on the back of information that I know is not in the market.
Right.
But basically,
Okay.
if you were to take a 4-year view, and if you were to believe that in 4 years' time we've got Blanket producing 80,000 ounces of gold a year, we've got Bilboes producing 170,000 ounces of gold a year. If you take an all-in sustaining cost of say 1,200, I'd hope it's lower than that. Pick your own gold price. You can work out quite easily what you think the annual cash generation could be. And then really the question for people is then to put a factor on that as to what they believe the risks of us achieving that are. But it is multiples, not fractions of an increase.
Okay.
Is that a clear answer? I'm not talking about it going up 20, 25, 30%. I'm talking about going up 2, 3, 4 times because we're very, very excited about where we can take Bilboes.
Yeah. Okay. To a more realistic question now is what should we be looking out for? We've spoken about you're moving forward with a number of projects. What's in your in tray as a matter of priority at the moment?
The priority is to demonstrably fix Blanket's performance on a quarter so that people can see quarter by quarter is back to generating 10-12 million dollars of cash flow a quarter. I think that's the core thing because that's the engine of the business, and hopefully we should begin to see that from sort of mid-May when we publish our Q1 results. Bearing in mind that Q1's a relatively short quarter for us, but that should build as the year progresses. We've already indicated in our 2023 financial statements, which we published a few weeks ago, that there is a substantial resource update coming at Blanket. So that will come through in either late April, early May. And then really the issue, as I said earlier on, the issue is how do we, within the constraints of our sort of regulatory requirements, convert the work we've done so far on Bilboes into a format that can be communicated to the market in a way that is intelligible. That may take that conversion process may take several months, given the work that needs to be done on sort of particularly the tailings facility. But I think that's the news flow you'd expect to see coming over the course of certainly the next sort of 6 months or so.
Yeah. Just one final question. How do you rate the London market at the moment? You're AIM listed, you're listed in New York, you've clearly got good exposure in New York as a Russell listed company. we've been hearing about some AIM-listed companies getting fed up with London and moving abroad or looking to move abroad. Any discussions around the boardroom table in that regard?
Well, we already are abroad. Let's be honest. It's not as though AIM's our sole listing. If AIM was our sole listing, I think we would be looking to go elsewhere. So AIM, our volume in AIM, it's a couple of thousand shares a day. It can easily in New York be 100,000 shares a day. So price discovery takes place in New York. In terms of access to equity, and let's face it, for a company like ourselves, markets like AIM, they're not casinos. They're supposed to be places where you're able to raise risk capital. I'm afraid to say that our best market by far for raising equity would be, believe it or not, Zimbabwe. We've found Zimbabwe, and you might find it hard to believe, but Zimbabwe is a much more fertile and deeper market for equity for us than New York. I'm afraid London doesn't come anywhere near either of those markets. So there's no need for us to discuss terminating the listing. There's no need for us to discuss going overseas. We are overseas, but it is disappointing to see that London is just becoming increasingly irrelevant, I'm afraid.
Yeah. Interesting comment, Mark. We'll have to leave it there, but thanks indeed for joining us. It's been a pleasure catching up with you again and looking into the future to see where things are going. Looking forward to catching up again, perhaps maybe sometime in the not too distant future to get a look at where things are going. That's Mark Learmonth. He's the Chief Executive of Caledonia Mining, the Zimbabwean-based gold producer.